Hey guys, hi. Hey, hi guys, can you hear me? Can you guys hear me? Mic test, can you guys hear me? So let me open the chat. Question and answer. Hey guys, hello. Hi Eric. Hi Mabata. Mic test. Hi there, mic test. Okay, let's give it some moments for the others to join before we begin this webinar. Okay, let's give it a wow. Hey, thank you, Eric. Thanks for the confirmation. Okay, let's give it a moment. Okay, well, we can start. Okay, hello guys, welcome to another IronFX solid trading webinar series. Well, today I will be presenting to you the martingale strategy. Okay, as usual, we will give the disclaimer. Okay, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. So do take some responsibility when you are trading and have proper risk management. Well, let me introduce myself. Okay, my name is Chen Yongqing and I am the trade analyst for the company. And we are the finalists for the best Forex research for 2019, 2020, and 2021. We are also the finalists for the best equity research for 2020 and also 2021. Just to remind you guys one more time, all trading involves risk and it is possible to lose all your capital without proper risk management. Okay, before we start this presentation too, let me head on to the IronFX YouTube channel. So you guys can actually take a look at youtube.com. I'll send the link in the description. You can subscribe to the IronFX YouTube channel where you can look at the past live streams, videos, and especially in the playlist, you can check out the previous webinars. They might take some time to upload, but it will be there. Also on the IronFX website, ironfx.com, you can find webinars like this under webinars, free Forex webinars, and you can start to register for it. Okay, my face is not up here yet. Well, it's fine. Well, it's fine. That's my team member, Tianing, Annabelle, Jindao, and Desmond Leong, who is our chief trader. Okay, without further ado, let's get right into the good stuff. Okay, today I'll be presenting the martingale strategy. First, we want to know, what is the martingale strategy? Does it work? Some examples of martingale strategies and the limitations of the martingale strategy. So today, before I begin this too, I would like to say that the martingale strategy is a very, very high risk. It's a high risk trading method and it's not for everyone. It's really not for everyone. So if you do plan to use this martingale strategy after this webinar, do really exercise caution and proper risk management. If you don't have proper risk management using the martingale strategy, you can blow your account. Okay, what is the martingale strategy? Well, it is based on the theory of increasing your amount even if the value is falling in expectation of a future increase. So what does it mean? You are stacking entries. So every time let's say you are taking a sell, you are okay, let's say you want to buy. So when price goes down, you buy. But it goes up nicely, but all of a sudden it continues going down. So your next entry, you actually double your lot size, double your risk. So it's, instead of 1 times, it becomes 2 times right here. So you buy again, but it continues going down. So your next buy, it becomes a buy 4 times for price to come back up. So you are actually averaging down to avoid your losses rather than you are seeking profits. I'll explain more into the next slide. Okay, so it is a high risk and a high reward. So what do I mean by high risk and high reward? Let's say you are buying. Let's say you buy 1 times. But when it goes up even higher, comes down, you buy 2 times. And continue going up, come down 3 times. So by the time it reaches up your lot size, there's so much. So let's say here was 1 lot. 1 lot. Your second entry became 2 lots. Your third entry became 3 times 2, 6 lots. So total adds your take profits. You would have a total of 6 plus 2 plus 1. So you got like 9 lots running to your take profit. So that is what I mean by high reward. But if it goes the other way around like this right here, you can lose a lot of money. Okay, the martingale strategy, the example, I maybe will use something like the coin flipping game. So let's say you are playing a game, heads or tails, a coin, you are just flipping a coin with a wager of $1. There's an equal probability, a 50% chance that the coin will land on either heads or tails. So let's say you bet on heads. You say you confirm $1, you confirm will get it, heads. But when you lose, you double it. Instead of risking $1, you bet $2. So as long as you stick with the same call, so continuously you continue betting on heads. So take it as heads, it's the buy, and tails is the sell. So you are continually betting. Every time you lose, you double it. $2, you lose, go on, it becomes $4. You're just betting and betting. As long as you stick with the same call, the same buy call, you would eventually, with an infinite amount of money, you can see the coin land in your favor. So this method works if you have infinite amounts of money. That's the reason why I mentioned that you have to use proper risk management if you are using this method. So I'll show you an example. You are betting on heads. You lose once. You lost $1. But the next one, you double it up and then you lose again. So total, you have lost $3 by here. So again, you double it up to $4 and then you lost 4 plus 3, lost $7. Then finally, you bet times 2, 8, you bet $8 and then you finally won. You won $8, but $8 minus 7. Your total, you only made $1. You only made $1. You only made your original here, your original bet after risking so much. So this is very high risk. Very, very high risk. I know revenge traders also do such thing. So if you want to talk about revenge trading, I might have some personal experience that I would like to tell you. So last time I did something pretty similar to the martingale strategy. So after I lost one single trade, let's say I did 1 lot. I remember I clearly did 1 lot. After 1 lot loss, I lost $100, so it was 10 pips. After that, I doubled my lot size to 2 lots. So I was hoping I'll get back 10 pips. I will cover back my losses and also make a nice $100. But the huge issue with that is there's a lot of greed involved. So it nearly hit 10 pips. So I was up around $160. That was 8 pips. I could have already broken even on my $100 loss and made a nice $60. But I did not do that. I let it run because I was greedy and wanted to break even and also make the $100. In the end, I blew that 2 lots. So total, I lost $200. Take it as here, 1 lot. I went up, and then I lost $200. Total, I lost $300 already. And then I continue so on and so forth, doing 5 lots, revenge trading. I remember I blew over $2,000 in one day just by revenge trading and not keeping my emotions in check. So that was way back. It was during the first year when I started trading. So let's move on to a brief explanation on the chart. So you buy one lot at the very top. So let's say you are a bad trader in an example. So you buy one lot, price continue going down. So you stack 2 lots, but price continue going down. Then you double it, 4 lots, hoping that the price can go up. Somehow you can break even. But price continue going down. So you buy 8 lots. By now, okay, for most of us, we are running out of the core money already. By then, our accounts have been blown. But let's take it as this trading account has unlimited money. Just take it as that. So price continue going down. You buy 16 lots, you double it. So with all the calculation in place, if price somehow goes back up, so it took very, very long. It took a few months before price hit break even right here. Hitting break even. So the 16 lots has to go up to cover all these positions to break even. It's so risky. So it took very, very long for it to break even. So it took around nearly a month just for break even. And for price to move up this small little tiny area, you made a small little profit, maybe 1%, depending on your risk. But this is the break even level. So yeah, it's very, very risky. You're just betting, buy 1 lot, buy 2 lots, buy 4 lots, all the way down, 8 lots, 16 lots. There's no end to that. There's no end to that until you blow your trading account. So I do know some people in my country. So I'm from Singapore. So I do know there's someone who is using martingale strategy. He programmed his own EA, his trading indicator, so it automatically starts to buy, or starts to sell when the market condition is trending. So if you notice, it works very well in a trending market. Works very well. So but if you are wrong, it's very, very bad for you, obviously. So let's take it as everything reversed to a sell. So you're selling 1 lot, sell 2 lots, sell 4 lots, 8 lots, and sell 16 lots. Going all the way down, you're making so much money. So it's actually working pretty well on a trending market, but not good if you got your analysis wrong. Hey, hi there, Richard. Nice to see you. So yeah, I'm just presenting about the martingale method, martingale strategy. Okay. Moving on, does it work? Yes, it's very popular. It's a very popular strategy in the Forex markets. Many beginner traders actually use that. Many of them use that. And it's unlike stocks, it almost never dropped to 0. And for this method to work, as I mentioned, you should have infinite amount of money. Because you will just double it every time you lose the trade until your account hits 0. You get the margin call. So really do take note if you are using this method. Okay, another example of a martingale strategy that is not going right in the favor, or it might be going right. So you buy 1 lot, price goes down. You buy 2 lots, price goes up. You close your trade right here. You would have made your original risk. So maybe if you risk 1% by closing right here, you break even on this 1 lot trade, but using this 2 lot trade to go up. So 1 lot, 1 pip, it's equals to $10. So 2 lots, 1 pip, it's equals to $20. So that's the reason why this 2 lot buy right here is able to cover your loss from the 1 lot buy, although you bought at the very, very top right here. So you continue going on. Example, buy 1 lot, but then you lose. You go down, buy 2 lots, it covers up, you break even here, and then you make 1%. You made it back. But the risk is very high. So buy 1 lot, continue going down, you buy, price goes up, you break even somewhere in the middle, and then you take your profits 1%. So yeah, it's very, very risky. It might work. It is possible to make money off it. You can make a lot of money off it. And you can also lose a lot of money using martingale. Okay, moving on to the next slide. Okay, I'll be talking about the reverse martingale, anti-martingale. So from the bottom, let's say that you are doing things very right. You are doing right. A safe. This anti-martingale, you are risking 1%. Only 1%. So you buy 1 lot, you move up, you cut your next lot size by half. So if the event price comes down, you can break even because your 1 lot buy is able to cover the 0.5 lot buy, which is going up. But instead it comes down, you break even nicely. So you buy 0.5 lot, price continue going up. You buy even smaller, 0.125. And then if price comes back down here, same thing, 0.5 lot is able to break even. And then you would have made money using on the 1 lot all the way up. So I know it's a bit confusing, it's a bit messy. But yeah, martingale, unless you are very, very good at your risk management and your directional bias is right, yeah, you can make a lot of money. But if you are wrong, you are just continuously going to lose money. So price continues going up, you halve your lot size. If it comes down, like in this situation, you would have broken even for this buy and this buy. This buy would have been a losing trade, but this 0.125 lots is able to break even your trade right here. And yeah, that's the reverse martingale. But what people normally teach is you just double your lot size, double it, 1 lot, 2 lots, 4 lots, all the way until you make money. So what are the limitations of the martingale strategy? As just now I did mention, your amount invested can reach huge proportions after a few transactions. It works very well. I need to emphasize this once again. It works well in a trending market. So trending markets, so price is going down. You think the market is on a bearish trend, so you continue doubling on the sell. So it works well in a trending market. And if your account has infinite money, that's the reason why a trader runs out of funds. They keep doubling until they get the margin call. There's no free margin anymore to enter your trade. And then the trades get exited, not by you, but your broker margin called your accounts, and you have no money left. Your losses phase can be disastrous, can be very, very huge. And the risk to reward ratio is not reasonable at all. So just now I did mention about the coin flipping game. So you just flipping your coin non-stop and double your size until you make back your original $1 that you are looking for. So high amounts are spent and keep losing until you win to earn back everything. The final profit is only equal to the initial bet size. So it's a very, very, I wouldn't say it's a bad method. It works well, since it works well in the trending markets, but it's as good as you are going to a casino. It's as good as you are going to a casino. If you lose, you are playing some kind of slot machine, lose money, you double it to earn it back, and you double, and that's how many people go bankrupt and owe money to the banks. They owe money to the banks because they keep borrowing money, keep doubling, trying to earn back what they have lost and get into deeper debts. So far, anybody has any questions, do let me know. Any questions at all? Or do you guys use this martingale method? Do let me know if you guys do use this martingale method or you guys are planning to use. I'll go on to the charts. Let me move on to the charts. Okay, let me load my webinar slides. Okay, let me look at the euro dollar. We might have something. Okay, looking at the daily. Let's say you are just looking at the daily. You don't really know how to trade. Let's have that in a current situation. So you can see clearly, price is in a bearish trend. Bearish trend, price is going down, but let me get the FIB channel. Okay, this is quite messy. I'm not sure why, but this is quite messy. Okay, never mind. I'll just draw it out using the. Okay, never mind. I'll just use a trend line for now. I want to use the FIB channel because it looks better, man. Yeah. So I draw the FIB channel up, and we are in a bearish trend. So resistance line. Resistance line. Just remember, if you want a varied trend line, it must have at least 3 touches. So what do I mean by 3 touches? So you have the first touch right here. Let me draw it clearly, everything nicely. We want it very proper. So price, 1 tap, 2 taps, and 3 taps. So this is a varied trend line. Next, we have at the bottom to confirm it, 1 tap, 2 taps, 3 taps, 4 taps, 5 taps. This has a higher confluence, a very, very high confluence that it is a varied trend line. Okay, let me clear this out. Okay, so you can see price has already broken this area, so we are not touched that. Let's move back to the martingale strategy. So it works well. It works well if you start to sell. If you get your directional bias right. So I'll just write it down on the chart. So you go up, you sell. Sell 1 lot. Sell 1 lot. Let me change it to 20. So you sell 1 lot, then you sell 2 lots. Although it's not the perfect entry. So you sell the bottom, sell 1 lot, sell 2 lots, and sell 3 lots. 4 lots, I mean. 4 lots. 8 lots. So you're just doubling and doubling, trying to, there are many people on YouTube, all those Forex gurus, they like to say, oh, you can double your account. Let's do a challenge. Challenge yourself to from $100 to $1,000 account. Then $1,000, they ask you to make 10K. Then from 10K, they ask you to make 100,000. Think about it. $100 to $1,000. Let me write it out on the chart to get that into perspective. $100 turn into $1,000 account challenge. All these kind of challenges is like nonsense, man. So you're actually trying to increase your account size by 1,000%. 1,000%. The only way to do that is to double up. You can do it on the martingale strategy. Very, very fast. Your account, if you're right, you can make a lot, triple your account or 10 times your account if you want using martingale strategy. So this challenge is like very, very high risk. So yeah, that's the reason why I mentioned always only risk 1%. So let's say you are risking 1% of $1,000. So let's say we have a $1,000 account in play. I'll say what, okay, or shouldn't say in play, accounts used for trading. So we want to risk 1%. So let's say you you'll be thinking, oh, maximum I want to do 3 sales. I want to sell 3 times only. So if the 3 sales didn't work out, I want to get out of the trade. So this I'll be showing you guys a anti-martingale strategy. So let's take you want to sell 3 times, or maybe 3 times. So you divide it out. Each time you enter, you're risking. So this one should be 4. Wait, let me do a calculation. 4, 2, 3. Maybe 3. 6, 9. 4. Okay, maybe you can risk this, the first entry. 0.1%. Let me type it out. Risk 0.1%. Yeah, so it's a bit complicated. Risking 0.1%. Moving on to risking 0.2%. 0.4%, I mean 0.2%. Next, you move on to risking 0.4%. So total you add up, what's the total so far? It's 0.7%. So including all your other commissions and stuff, total add up, it should be around 1% or close to that. So in a situation where you are risking that 0.1%, let me calculate it out. So you take your $100, you divide by, let's say you are going for a buy. You are wrong in this situation. So you are buying, you are doing martingale, you are trying to buy and buy and buy. So this is a nice way to manage your account. Buy, buy, buy. But this is only on a 1% risk on a $1,000 account. So you risk 0.1%. Let me count, $100. So your stop loss, let's say you buy at the very, very bottom, your stop loss at the very top somewhere. Okay, this is not a good example. Okay, I'll just have an example. You do, it's according to your stop loss. So you buy, let's say on a $100 account, 0.1 lots. But as it goes down further, hits 2, you start to lower your risk, increase your risk to 0.2 lots. You move on to buying 0.4. So it adds up, adds up, adds up. So it goes down, and then if it hits your stop loss, buy. You keep hitting your stop loss, buy, keep hitting, and the final stop loss hits, or the account closes, and you would have hit your stop loss, and then you would only lose 1% of your account. Okay, do let me know so far if you want to implement this on your live trading account with your hard-earned money. Do you want to do that? Yes, no, yes. That's smart thinking, bro. Yes, do not use that on your live trading account. I mean, some people is working well for others. I've seen someone in real life, he used martingale strategy on his personal EA. He has these bots. So price continues trending, and he has a EA. He keeps buying. So it works well in the trading market. I actually saw he made a lot of money on a very, very small account. So he basically tripled his $1,000 account. At the end of the month, is around 4,000 over, nearly 5,000. He 5 times it. But then the following month, price reversed, and he continued losing money. Yes, it's far too risky. It's way too much, man. It's must as well go to the casino, right? Go casino, throw your money there. At least you might have a chance. You might not. It's the same thing here using martingale. You're just betting that the market is trending downwards. So yeah, it's far too risky, Eric. Yes. So yeah, for me personally, I use something called, maybe if you guys are interested in my own personal trading method, I use smart money concepts. Have you heard about that? Smart money concepts. It's been working quite well. Smart money concepts. Okay, what trading method do you use, Eric? Do let me know in chat. Let me know what kind of method you guys are using, and the others that are watching too. Please don't be shy. Just send your trading method in chat. There's no right or wrong. Every trading method is subjective. There's no right or wrong. Okay, I'll just type out my trading method right here. So we are looking at the euro dollar. Smart money concepts. Okay, I'm using this method, smart money concepts. So I'll just simplify it for you. It's pretty, okay, I'll try to simplify it as easy as possible to understand. So if you're looking right here, I'm using the company's trading view account. So on my personal trading view account, I do not use any indicators. Zero indicators. I don't use any, zero. So zero indicators involved. So you can see everything is off. So if I turn it on, it will turn on, everything will turn on. So I use zero indicators. I don't use any of it. What I like to do is I like to mark out the previous daily high and previous daily low. So I'll get the trend line. A trend line. I'll just teaching you guys a method that I use that I managed to turn it profitable. It was a profitable method. There is no indicators used. So when I'm marking out the previous, what we are looking for is the previous daily high and previous daily low. So I'll type it out, previous daily high. And next we have the previous daily low. So if that's marked out, what you want to have is a daily bias. So the daily candle, you want it to move up or you want it to move down, you must have a bias and you must have some kind of story. So I like to craft a story. It's like I'm drawing art. I like to craft a story on why price did that, price did what it did. So looking to the left, okay, I wouldn't look to the left, it's too far. Okay, let's look at a more recent area, like this area. Why price bounced or why price reflected off this area? There must be a reason to it. I always want the reason. So if I zoom in very, very carefully, have you guys heard about liquidity? Liquidity. So liquidity is resting right here. You can see all these wicks. This wick price, what did it do? It came down, cleared this liquidity before it continued going up. So I'll mark it out nicely on the chart. This is on the daily chart. I'm just getting a story, just crafting things up. So I'll draw one line trade. I'll change it to the sell side liquidity got taken. So I have a story why price bounced. If I zoom in very carefully, you can see very, very down. Can take a look here. Price came down. Just imagining as the market, it's like a magnet coming down, just to clear your stop loss. So you have a stop loss here, you cleared your stop loss, getting liquidity, cleared it out, getting liquidity before price continue moving higher. And then same thing right here, price cleared liquidity. Where was it clearing? Let me draw a line. Sell side liquidity taken. So you can see I'm not using any indicators. I'm just drawing out what I see on the chart. So liquidity was taken over here and over here. So take it as the market, same thing, came down to clear your stop loss, getting that amount of cash, getting people out of the market before price continue moving upwards. So with that, price continue moving upwards, but why did price reflect? Why did price hit down? So using smart money concepts, we have something called the demand and supply zone. So if I draw a box, we get everything out. So we draw a box right here. A red box because it's a sell. So you can see price tapped into this supply zone before it refracted down, cleared the liquidity area before it continued up. So same thing. If you want to start going at the smaller time frames, daily, price also cleared the liquidity right here. Before it reflected down, it tapped into the supply, reflected down, cleared liquidity before it moved higher. So since we have crafted that story out on what price is doing, we move up further. So price also cleared the supply, the entire supply area before it reflected down. So adding on, there's liquidity lying down here, lying right here at the top. So it cleared, it exited out this area going up, clearing out all the stop losses. Just imagine it as that before touching into the supply zone and it reflected down. So we are getting closer and closer to the story of what is happening on the daily at the current market right here. Okay, so with the liquidity cleared, I will just draw it out. Trend line. Okay, the magnet too. I'll set this as the buy side liquidity. It got taken out before it reflected right back down. So if you guys can actually screenshot this if you are interested. Smart money concepts, my psychology for this, I like to say that I like to use precision. By trading, I want precision. Psychology. Why psychology? You must have a very, very strong mindset. So if you have a very, very, very weak mindset and you are using the martingale strategy, as I mentioned earlier, I don't think you guys can hold the trade for long if you do not have a strong psychology. You will be in deep losses, continued losses. And by then you would have potentially closed your trade early and potentially blew the account earlier than expected. So psychology, precision, and market facts. Why am I talking about market facts? Why market facts? Just like I mentioned, liquidity. There's no argument, there's zero argument to say that price came down and did what it did. Because it's clear, it's on the markets, it's on the chart right there. Price literally came down to clear liquidity before it bounced. And price over here too, clear liquidity, and then bounce. So what I like to call this is inarguable. You cannot argue the market facts that is presented itself on the chart. But what can be argued? What is not a market fact? So, you know, many retail traders, they like to draw trend line. Wow, they like to draw a random trend line. They say, wow, price is going up here, going there. And right here, price has already broken. Oh, it's broken, it's coming down. But if you take another trend line, you draw it this way, price is still above, it's still trending, it hasn't broken. So it's very, very subjective. It's not a market fact at all. It's not a market fact at all, man. So huge issue with this is if I ask 100 people, 100 people sit down in a room and ask them to draw a trend line, say, oh guys, everybody sit down, here's a pen and paper, here's your chart, or here's a laptop. Everybody gets a laptop and then you draw a trend line. Show me where the market is trending. So people will draw, wow, they have a trend line. Some people use this trend line. Some people draw it like that. And they say, oh, we have markets broken, market structure broken, trend line broken. Or some people even use the body of the candle. Use the body and then they're trying to move it. They move it around. And they can say that price just reflected. They can even say price just reflected the trend line. So that's the very huge issue with drawing trend lines. It's very, very subjective. Everybody draws their trend lines differently. So that's what I like to talk about, market facts. It's not a market fact if everybody is drawing it differently, right? It's not a market fact at all. So what you want is the market facts that liquidity was cleared. This cannot be argued. You cannot say, oh, price came down to here because there was something. No, liquidity is presented itself on the chart, especially right here. Liquidity cleared, liquidity right here cleared before price finally cleared, tap into the supply zone before it continued downwards. Okay, moving on. So since we have got a idea on what is going on in the daily, so we have already crafted, I've given you the story, what is going on, why price move the way it is. I want to know everything before I start trading the pair. So I do not trade multiple pairs. I only focus on the euro dollar, euro USD. So I got my entire mind. So I'm just looking at the charts. I know exactly what happened on the daily. I don't have to redo my charts. So going down to the 4 hours. Okay, maybe before we move on to the 4 hours, I spotted liquidity resting right here. Why is it resting right here? Because there is a equal low. Equal low candles are liquidity. So I'll just write it out right here. Write it out here. Equal lows. Equal lows. So I spotted an equal low there already. Moving on to the 4 hours. I also continue. I want to craft what is going on. What is going on right there. So you can see right here, price, where is price currently at? What I like to talk about a lot is market imbalance, market inefficiency. So if you look at this candle, do you like it? Oh, you like it? Oh, it's just smash all the way down. Then you say, oh, I can look for a buy or I can continue selling. But with a candle that big like that, and then you still want to sell, do you think price can continue going down? No, because when people see such a candle like that, they start to buy. They start to buy up. So we have something called a retracement. So using the retracement, we are looking at the market imbalance, that is right here, the market inefficiency at this area. So price is currently inside the inefficiency area or the market's imbalance. So let me use a Fibonacci to draw it out. Let me draw it out nicely for you guys to see. Where is it? Fib retracement. Now use my fair value gap. So if you look very, very nicely, first of all, do you have any questions on how to spot market imbalance before I continue? In case it confuses you guys. So market imbalance, you can see very nicely, price is inside right now at the moment. Market imbalance is very, very useful to find out where price might potentially head to next. So you can looking back at old data right here to prove market imbalance. Same thing, it is a market fact. There is a market fact that there is an imbalance there. It cannot be argued. It's presented itself on the charts. There's no way that you can say, oh, there's an imbalance at some random area. Nobody will. It's impossible to argue on that. So you can see here, there's a market imbalance resting right here. Price came in, tapped, continue going up. Market facts. Price came in right here, tapped into the market imbalance before it continue heading up. So yeah, market imbalance inefficiency is very, very important in trading. I know there's something new. I don't think there are many people who talk about market facts. What is a market fact? So yeah, I like to present my trading style as market facts. So setting the market, okay, let me redraw the entire fib. So we have a market imbalance there. You can take a look. Price tapped into it before it continue bouncing up. So next, look at this market imbalance right here. Very, very tiny one. Right here, price came in, tapped, and it continue moving up. Same goes to here. The huge issue with this kind of trades, this kind of huge entries, is there is a very huge market imbalance. You can see right here, price actually came in to have a minor tap before it continue upwards. But what I don't like about this market imbalance, about this specific area, is because it is not mitigated. Mitigated, I'll type it out in chat. Mitigated. So what is mitigation? What is market mitigation? I want it to at least be close to the 50% area. You can draw it out, can take a look. I'm using a gun box. So I prefer it to be quite close at this area, the 50% equilibrium before it continues going up. But for this case, we might expect, since it's not mitigated, we might expect for price to possibly, let's say if EU is continued to be bearish, where is the forecast line? Where's the forecast? I normally just start it. Where is it located? Okay, so we have the projection line. So we are looking for, if EU is possibly continuing bearish, we can look for price to, okay, why is this not the right tool? Okay, the forecast, we can look for price to tap into the, okay, I need to hide all these text nonsense. How do I hide all these source text? Source background, none, I don't want it, none of that. Hide all of those. Opacity, none. Target border, none. Background, none. None, I don't want all of those. Give me a moment. Okay, with that being in place, let me see. Okay, there's still something. Failure text in white. I don't want any of that. Okay, so forecast, it's possible for price to come down. This is on the 4-hour chart, to come back down to mitigate these 4 hours markets imbalance that was resting right here. So I'll just write it down, a very, very quick one. Where is the call? Okay, I'll name this as the H4 unmitigated markets imbalance. So right now I'm just drawing what I see on the chart, which I presented as market facts instead of using indicator. So if you use multiple indicators, moving average, RSI, all these kind of other things, it may not show the same, sell. So one indicator can indicate selling, another indicator state buying. They are just lagging indicators using calculations, using formulas to tell you where to buy, where to sell. But I don't like to use any of that. So I would rather look at what is presented to me in front of the charts. That's why I want what is presented on the charts before I start my trading. So with that forecast in play, it's possible that price might come back down to clear this H4 unmitigated market imbalance. Well, since we are, just now I did mention we are currently in the H4 market imbalance, let's dive down to the 1 hour. To the 1 hour where we can potentially see what is going on. So in the 1 hour, we have actually tapped into the 1 hour. So I'll move this up, the 1 hour market imbalance. You can see right here, it's very, very clean and obvious. It's very, very clean. So price tapped into that, just had a minor tap before it rejected almost immediately. So yeah, that's the market imbalance right there. So tonight, later on, we have the FOMC news. So if you're trading euro dollar, you should be careful on your trading. So yesterday, let's take a quick look at Forex Factory. Take a look at Forex Factory. Yesterday, the construction spending was better than expected on the USD. Previous was minus 0.6%. They forecasted minus 0.5%, but it turned positive 0.2%. So it's insanely good for USD. So even the job openings was better than last month and way better than expected. Way higher than that, man. It's like plus 1 million on top. So yeah, I was looking at these two. So these two gave the very, very good news for yesterday for USD. 10 p.m. So Euro USD plummeted with the DXY strengthening. So I'll just do a quick one on why the construction spending is very important, although it's a yellow color news. You are thinking, why am I looking at that? It's yellow color news. Why do I care so much? Well, what you are learning from, I learned this from someone who used to work in Goldman Sachs. Yeah. So this is a secret. This is a secret source. So for those who are here, you are very, very lucky to be learning. You cannot find this on, I don't think you can find it on YouTube. You don't find this anywhere. So it's a secret, although it is a yellow color news. So construction spending, just think of it. Construction spending increased to a positive side. But where do they get the money? Builders, they need how much money to build a house? So maybe build an entire apartment, they need $1 million, few million, but where do they get the loan? They need money, right? So they are getting money from the bank. They are getting money from the bank. So the bank is lending them money, but for the builders to build the houses. So the builders are spending more money to build houses, but why? Why on that? They are expecting that they have people who are able to buy the houses. So if people are able to buy houses, the banks will lend the people money to be able to buy houses, and at the same time, they are lending both builders and people to buy houses at the same time. So this tells us that the banks think that the economy is improving. So yeah, construction spending is a secret source. So yeah, yesterday, due to that news, I immediately shorted Euro USD. So you can take a look right here on the 1 minute chart. So I'm usually on the 1 minute chart when I'm trading. So I just take a quick look back on the hour first. Right here, the liquidity right here got taken out. So if you draw a quick line over, this is just a trade recap. So the buy side liquidity got taken out. Price cleared, went up, cleared liquidity before it went back down. So you can see right here on the 1 minute chart. I'm on the 1 minute chart last night. So with the buy side liquidity cleared, looking down, right here we are on the 1 minute chart. Price, let me get the arrow out. Cleared, broke structure right here. I'll take it as the break of market structure. So it broke market structure, and then I entered a sell right here. Sell right here because of the market imbalance resting right there. You can see very closely. A quick one, very, very quick one. Market imbalance resting right there. So I sold it there. Sold it there and then. Let me get the short. Oh my God, it's not. Okay, it's here. Okay, I shorted it right here. Price retraced up, back up with my stop loss above. 8.9 pip stop loss. And then where did I go? Let me go back to the 1 hour. 1 hour chart. Okay, it's right here. I take profits when I closed at the next pivot area or the previous low. So when price reached here, I immediately closed. So it was a 1 to 8.37 risk to reward ratio. So you might be thinking, oh, that's very, very unbelievable. How are you able to do that? It's on the 1 minute chart. So, and then with the fundamental news in play, let me show you. So yeah, here you can take a look. That's actually shorted EU down all the way from the very, very top. It's the same chart. So this was yesterday. I shorted it from the very, very top on the 1 minute chart using smart money concepts. So break of market structure is just like that. Break of market structure, imbalance, sell all the way down. So it increased my account by 8%. So yeah, and today I'll be taking it pretty chill due to the yesterday's profits. And tonight we have the FOMC meeting. So expect a lot of volatility in the markets. So yeah, 4 hour chart, let's get back to it, clear this out. So yeah, this is just how I trade. I don't use any indicators, I just draw it out nicely. So do you have any more questions before I end this webinar? Any more questions? If you want to learn smart money concepts, you can find it on YouTube. There are quite a few people who are teaching smart money concepts for free. So yeah, any more questions? If not, I will be ending the webinar. So I just presented my personal trading style. So how I trade. Oh no, thank you. Hey, no worries, Eric. Hey, thank you very much for the support. Thank you for listening to me, man. Thanks, Eric, and you have a good day and safe trading ahead. So tonight's just a reminder, the FOMC news is coming out, and Friday we have NFP. So this week I'll be taking it rather chill, rather relaxed. Nothing much. Hey, thank you, man. See you, man. Hey, bye, bro. Bye. Hey, thanks for attending.